Good evening, and thank you very much for joining us. We're going to wait a few minutes as people start to filter in to the webinar. For those of you who don't know me, my name is David Hansel, and I am one of the founding members and managing partners of Lucern Capital. I'm joined with my friend and business partner, Frank Forte.
Nice to meet you.
Lucern is a real estate private equity firm that primarily invests in industrial and multifamily assets with a focus geographically in the Carolinas. We are located up in New Jersey and have made investments in the Northeast as well, but we are really focused in the Carolinas. So our goal today is to share with you the latest investment offering that we have, to talk to you about why we're purchasing it, and what that would look like for you as an investor if you were to join us. We're going to dig in on a lot of different topics, and at the very end we're going to open up for some Q&A. So throughout the webinar, if you want to write some questions down on the side in the chat, we'll try and answer as many as possible. I think we'll get started. Again, my name's David, and this is David Hansel, and this is Frank Forte. We're managing partners at Lucern. And we're going over this property, Indeneer, which is a light industrial portfolio located in Kernersville, North Carolina. This is 4 separate buildings with 5 tenants. We'll drill down later on the tenants and why we think they make a good fit for our property. The high-level numbers that you see up here talk about return metrics and the duration of your investment. This would be a 5-year hold, although we could certainly sell a little earlier, but likely we'll be holding this asset for 5 years. We're intending on providing a 1.85 multiple, meaning that you'd make an 85% return on your invested dollars over the life of the investment. And part of that comes through cash flow, which is 7% average annually over the life of the investment, and targeting a 14% IRR. I'm going to get through some boring stuff first, and then we'll dig in and really start talking about the asset itself. So some housekeeping from a disclaimer perspective. This is not an official offering. The private placement memorandum that we will share with prospective investors would constitute the official offering. We strongly encourage you to speak with your accountant or attorney for any legal or tax advice. And lastly, anyone that were to participate with us must be what's called accredited. Accredited investor is typically one of 2 ways someone would qualify. You don't have to qualify for both. It could be one or the other. One is income. If under income, it's $200,000 a year or $200,000 for an individual, $300,000 a year of income for a married couple, and you've had to have earned that the last 2 years and project that you'll be earning that going forward. From an equity standpoint, you don't have to have the income. Let's say you're retired and you don't have a lot of income, you can qualify under net worth. And the requirement is $1 million of net worth, not including any equity in your primary residence. So now that we got that out of the way, let's dive right in. Kind of executive summary here. We put some big bullet points on the right-hand side, and we're going to drill down on these topics throughout the presentation. But this, as I mentioned, it's a 4-building portfolio. We're purchasing it for $4.1 million. Very conservative on the debt. We're only getting 57% leverage, which helps on the risk profile, and we'll get more into that later when we talk about the debt. And we're raising $2.21 million of equity. Those are the dollars from us and from the investors that will pair up with the debt. We're going to kind of skip through to the next page right now and talk about some of the benefits of this investment, and Frank will dig in. I do want to mention that the property is currently 100% occupied and cash flowing. The location we'll do a deep dive into. And again, low leverage, provides a good risk reward for you. So let's talk about some of the investment highlights. Maybe Frank, you can share
Sure.
some of the details from this page.
Yeah, sure. So a couple of investment highlights. So as David mentioned, obviously it's 100% occupied, right? Historically, the property has had strong collections. So these are small to medium-sized businesses. You have a business like Sunbelt, and we'll touch on some of the tenants later. It's a huge trucking company. They do tens of millions of revenue a year. And this is one of 5 locations, to smaller mom and pop type businesses, right? Like CrossFit and everything in between. So collections have been 100% through the seller's ownership. There's been, relatively no delinquency problems with the property. Rent growth potential, right? So that's part of the reason why we buy assets like this. They have an ability to be marked to market, right? Which is the phrase, taking where the rent is today and adjusting it to market upon rollover. So right now we're somewhere around 5.25 on the rents per square foot, and we anticipate about 32% blended upside, on a weighted average basis across the rent roll. Strategic tenant rollover, right? And you could also call this staggered tenant rollover. If you look in the offering deck as we go through, or if you look at it after the presentation, there is a varied kind of rollover of tenants throughout the life of the deal. One thing that is interesting to note is that we were able to secure a renewal for Artware, which is the largest tenant at 25,000 feet, in conjunction with the seller. Seller we've done business with before. We have a great relationship, and we were able to secure this increase as a way to take the largest tenant's role out of play for the whole period. Successful renewal, that's the next bullet here you'll see, which is what I already discussed. There's also some untapped potential in a plot of land. 0 Indeneer is the address. It's directly adjacent to one of the buildings we're buying as you come into the park. And that is interesting because it could yield development potential for another building, could be sold. Indicative early appraisals are somewhere between 150 and 180,000 of value on that land as it sits today. And then finally, there's this thought of cost optimization, right? So we're going to be managing this property in-house as opposed to using a third-party property manager. We will be charging market rate management fees, but certain functions which normally we would pay for, we'll be able to utilize our internal functions, and it'll be at a much lower or eliminated cost altogether. So it'll allow us to operate a little bit more efficiently, ultimately drive more value to the bottom line.
Thanks, Frank.
Sure.
So with any investment, the location is extremely important. And the next 2 slides, one is just about the general market for industrial in this area. And then we'll go one step further and talk about Kernersville, the town that the property is located in, and access to highways and transportation. So Frank, why don't you talk about the environment?
I was going to say, it's a great spot for me to hop in. So, a lot of what we're doing here, right, we're identifying properties that are, supply constrained, right, or have supply-demand imbalances that are favorable. Spaces that are in demand, you cannot build more of them. It's really difficult. They're well located, so on and so forth. And, we talk about this a little bit, David and I, a lot of the same metrics that we identified back in 16 and 17 in the workforce housing space before everyone sort of piled into that are a lot of the same metrics we're seeing today in this space, which makes it really, really interesting. And there's actually a lot of parallels. So let's talk a little bit about it. So one, building under 50,000 square feet of light industrial product, it's very, very difficult and challenging. One, availability of land has pretty much dried up, right, in the Southeast, especially around places you want to be. Primary, secondary markets has dried up. It's been developed. Two, a lot of the spaces that have been developed over time, that land that we talk about that came offline, it was developed for what we call bombers, right? 500, 750,000, million square foot, Amazon, Boxed, Walmart, Chewy, any big company, and there's hundreds of others, right? North Carolina's 3-to-1 manufacturing jobs versus the rest of the country, as well as logistics. So you have this interesting dynamic, but that land, developers saw the highest and best use as these big facilities where they could lease to a single tenant and go on their way. And as a result, multi-tenant industrial has largely been overlooked from a build perspective and supply. And given the fact that it's smaller, costs are up during COVID and after. Labor is really difficult to come by. We know this. We see it in the construction market, right? We see it in the housing market even. It's become really cost inefficient to build that product. And as a result, there's a high demand and not a lot of supply. So that leads to an increase in rents, and it also leads to a really attractive investment. So part of what we're doing is identifying these areas that are well located, right? From a logistics standpoint, from a distribution standpoint, confluence of highways, strong industrial corridors, so on and so forth. And two, identifying areas where there's very little supply. So Kernersville, which I think it's a good time to pop into Kernersville. Kernersville, it's really strategic, right? So it's in the Triad. What is the Triad? Triad's Winston-Salem, Greensboro, High Point. Kernersville is an affluent suburb of Winston-Salem, but what makes it particularly interesting is it is right on I-40. So I-40 ends in Wilmington, North Carolina, which coincidentally we have some other investments in, and it goes all the way to the West Coast. It's actually one of the longest interstate east to west highways in America, right? So Kernersville is located essentially on I-40, and this investment that we're discussing tonight is within a couple miles of I-40. So the connectivity is unparalleled. Who do you have in the area? You have other institutional owners, one of which you just sold, Dogwood, owned by TPG, Texas Pacific Group. You have Link Logistics, Blackstone's logistics dropdown. You have Carlyle, you have Stockbridge. I mean, the names go on and on that own in this pocket. So from an industrial location, it's really well trodden. It's totally vetted from not only our perspective, but obviously from a lot of large players as well. And then you have innumerable owner-operators, large distribution centers that are nearby, people like Red Bull, right? Huge furniture companies, mattress companies, the list goes on and on. So we're really close to this huge interstate highway, and that also gives us the ability to access other highways for north and south connectivity. So Kernersville, it's really strong. The Triad in general is very, very strong from a logistics standpoint. You can access Raleigh, you can access Charlotte, you can access Atlanta, and going up towards Richmond and DC. And then of course, east to west, things that come to mind are, Memphis, Nashville, and so on and so forth, going all the way out into the Midwest. And then of course, terminating in California. So really strong location for logistics and really important.
And I think one of the other really interesting points is that the vacancy rate for this product in this
I was going
market
to mention that.
is floating around 2%, slightly below 2%, right?
Yeah, in some cases it's about 1.5%. So, and that just again owes to the fact that you really can't build this product. And we'll touch on the tenants, but if one of our tenants is a cleaning company, they've been in business since 1993. They service the whole Triad. They have 250 employees, 40 trucks. It's really important for them to be proximate to the highway, right? Because they need to get in and out to service their clients. That company is not a company that could ever lease 50, 100, 200,000 feet, right? The economics wouldn't make sense. So there's a lot of these companies that need space and have nowhere to go. And that's why you see vacancy being tight.
And before we get into the quality product, which we'll talk about the asset itself, the physical asset, on that vacancy, I want to talk about square foot, the cost per square foot. We're coming in and buying this at approximately $80 a square foot. Right. And today, with the cost of labor, materials, land, approvals, it's every bit of $200 a foot to build a similar product. And the reason why that's so important is not only are we getting at a steep discount to it, but the likelihood of new inventory coming to market to help with the lack of supply is de minimis. I mean, it's not likely to happen. So we think that we're going to benefit from this extremely low vacancy rate and help us continue to market the rents.
Yeah, so a little what I mentioned earlier regarding these bombers, right? These larger buildings. Part of why it makes sense for a developer to do that is because when you get to that scale, the cost per square foot to develop a tilt-up, big logistics warehouse, very simple, no office, right? Just big 36, 40 foot clear building. Is you can develop that in the low 100s, right? Maybe 110, 115 a foot. Something like this, the hard costs alone are more than double where we're buying it for, maybe a little bit less than that. And then you include land, and the unavailability of that drives that up. So it's a very stark difference. So the rents that you would have to achieve on a new construction product would be so high that you can't achieve, the market doesn't support that, so the product doesn't get built, right? Yeah. And that's a little of what we're talking about here.
And we'll quickly go through this, a couple highlights through this slide. The product is around 2000 vintage, as you could see, built in 1999. Some of the other photos throughout the presentation you can see, but it has a brick facade, brick and metal facade, very clean. All the buildings, the roofs and the parking, everything's in good shape. We'll talk about, we do have a reserve for $100,000 of CapEx, although we don't have anything specific targeted for that. But to err on the side of caution, we always like to put some money in reserve for a rainy day or an issue that could show up. So really, really nice. We have one of the structures where Sunbelt, the moving company that has literally 3 sides of the building, is wrapped with bay doors with rather backup. What do you call it?
Yeah, it's the what David's trying to kind of say is that Sunbelt, it's a truck terminal, right? It's a standard truck terminal. So you have 28 bay doors, which is what you're getting at. And what's really cool about it, though, is it's on 3 acres total. And truck terminal buildings have become of great importance, right, in the last several years through COVID. And we believe that building is it's really valuable, of course, and tenant's great. But it's a really nice, I think what David's trying to say, it's a really nice diversity of product, right? So we have somewhere like Artware. It's a light manufacturing building where they're doing all this embroidery work and all this stuff. You have another fabrication company in the building across the street. You have a CrossFit gym. You have Carolina Services. It has a drive-in door, and then you have Sunbelt, right, which is a truck terminal. So there's a really nice diversity of product for what the average user would come in and seek.
Yeah, and so the next slide kind of shows the rollover of leases. So obviously, if everyone came due at the same time, that could pose a potential issue, because if everyone wanted to leave, which we feel pretty strongly that all the tenants would likely stay, maybe CrossFit might get turned over. We have no definitive information on that, but just from our interviews with all of the tenants, we feel that they're pretty strong. But why don't you talk about how this helps to de-risk the deal and talk about Artware, embroidery, if you don't mind.
Yeah, sure. So, when we talk about rollover, right, it's no secret. One of the things that makes multi-tenant appealing is not dissimilar to why, people like apartments, right, where there's a really significant amount of tenants and you lose 1 or 2 depending on the scale and you don't get hammered, right? And here is the same thing. We like and prefer multi-tenant because it gives you an opportunity to still generate cash flow. It's not a binary event, right, where you have a tenant or you don't, and there's cash flow or there isn't. And in this case, being staggered, if we were to lose a tenant and it takes time to re-tenant, you're not at a position where you're carrying the mortgage every month. Maybe cash flow is significantly tighter. Maybe even it's flat, after debt service, but you're not in a position where the deal is negatively cash flowing. And that's really important. So with this dispersion, and some of the interviews we've had with tenants and indicative conversations, the risk, in our opinion, of losing a big tenant in a big way that's super impactful to cash flow is much more reduced for this deal particularly. Now, Artware is really interesting, as I mentioned it earlier. So they've been in the space since 2005. They are one of the largest embroidery companies on the East Coast. They actually embroider 10,000 items a week, which is completely insane, and have a number of really nice contracts that it's not, I can't disclose them here publicly, but a very large clothing manufacturer that everyone who watches this will know who it is. They're an exclusive embroiderer to that company. And then a very large golf brand and lifestyle brand that they do all the embroidery for that. And they have some contracts that allow them to do apparel for major, golf and other sporting events of that type. So, and then in addition to that, they do corporate swag, they do all this stuff. So they're well insulated. They do a lot of business. They've been in this location a very, very long time. The location is mission critical to them. They do not have another location, and most of their larger suppliers are in the Raleigh and Greensboro area. The trucks will make the rounds from those areas to Kernersville. So they have to be in this location, and it's important they're off of I-40.
think I just want to add one thing to this.
Sure.
So I mentioned that these are staggered leases, and we do think that these tenants are likely to renew. In our underwriting, we plan for the tenants not to renew.
That's right.
And have vacancy during a period of time and fit up and so on and so forth. What's nice about that is that if any of the tenants do renew, which we believe most of them will, or if not all, that extra revenue will come to the bottom line and help the returns. So
That's
whenever we look at a deal, we try to be really conservative in our assumptions. So hopefully we'll have some pickup on that, but that's pretty much it on the tenant side. I'm going to kind of quickly go through the project parameters. We touched on some of these throughout the presentation, but again, the purchase price is going to be $4.1 million. We're going to put $100,000 of capital expenditure in reserve. We have about $344,000 in total closing costs, with a total project cost just a little bit over $4.5 million. And again, we're looking to raise $2.21 million in equity. For those of you that do want to join us, you'll be able to correspond, and we'll talk to you, and we can do calls offline to go over additional questions that you may have that we don't get to answer today. Again, 14% IRR and 7% cash yield. Moving right along, this is just a chart that we put together to show the hypothetical growth on $100,000 over the life of the investment.
Yep.
So if you look at the total distribution column in the center, that really shows what cash flow you'll be getting paid based on our assumptions. And you can see that it moves up over the years as we start to increase the rents. In year 5, we actually have the largest pickup of rents that's blended into that sale number. But you could see at the bottom that $100,000 investment would become $185,098 if we hit our targets. And our goal is to hit that or outperform. So that's pretty straightforward. I'll let Frank talk about the debt piece, which is always important. One of the things that we'll point out is that it's fixed rate debt, but let Frank go through and share with you the debt that we have for this project.
Yeah, no, that's a good point. So as David pointed out, it is fixed rate debt. It's important in this space. Industrial, one of the things that's nice about it is the leverage is lower, right? So these returns are pretty strong even with low leverage. And, on top of it, it's amortizing. So over the last few years, debt markets were frothy. The world was really frothy, before, unfortunately, the last year. And, next year may be difficult for the markets, but a lot of people are offering interest-only debt in a very low amount. So this is a market rate piece of debt that's also amortizing, which means as time goes on, every period that we pay, right, monthly, a portion of that payment goes to reduce the principal balance and effectively de-risks the leverage over time. So it is a 30-year amortization. Lenders were able to achieve that here. Traditionally, industrial is more like 20 or 25. Part of the reason we're able to get 30 here is it is a very good quality product. It is well located. It does have a strong demand, and so we're able to get a 30-year amortization. So we're going to be levering this at 57% of purchase price, 51% approximately of cost, meaning the entire stack, how many dollars are going in versus the debt. So that basically means essentially almost an equal amount of debt and equity is being brought to the deal, right? So that's a big cushion from a lender's perspective. And then lastly, I think one of the things that's really important is that it's step down prepay. So what that means is that, in year 1, if you were to exit the deal, you would pay 5% of the loan balance as a penalty. Year 2, 4, 3, and so on and so forth. And the reason that's important is a lot of debt does not have early exit options, right? And you pay a huge penalty, what's known as yield maintenance. You essentially pay for the rest of the yield the lender would have gotten as a penalty for getting out. The thought process being, if you're exiting early, you're doing so good that you don't care. In this case, the step-down prepay effectively limits us, and we understand what that penalty would be. For example, in year 5 or in year 4, it's 2%. if the loan amount is 2.3 million and we expect it to be lower as a result of amortization, we know our payoff would be 2% of that, or in this case, if there was no amortization, 46,000. It's a defined quantitative number. So all in all, given where we are in the interest rate environment, it's a really good piece of debt. The leverage is solid, it protects us and it protects the investors. The returns are still really strong, and it's amortizing.
Great, thanks. Real quick on the management of the property, we're gonna handle the management in-house. We use Rent Manager that helps with all the billing, the CAM charges, everything in it. I don't know if you want to add anything to this, but pretty cut and dry.
No, nothing to add other than it's one of the oldest property management softwares that's out there. It's very robust. It's great for what we're going to do, and the cost is really fair. A lot of newer software that's come out that has less features, but it's fancier, so to speak, or fancier looking. The cost is a lot more. So it's robust, it's utilitarian, it's exactly what we need.
Right.
Yep.
I'm going to skip through this. I mean, we kind of touched on these two tenants. It was just the highlight of the tenants. We're starting to wrap up on the deal side, and remember, please put your questions down below when we finish. We'll try to answer as many as possible. We will go into a little bit more background about us and the firm after I finish this up. So not too much longer, but I want to talk about the waterfall and the fees that are being charged. So first off, we plan to distribute to you as investors every quarter with a quarterly update, giving you detail about how the asset's performing. All this is sent through our IMS investor management system. And we're obviously always available to talk as well, but you will get a quarterly update and distributions. The management, there's no asset management fee, which is something that we typically would charge. There's only a property management fee, and that's for running the property, billing the tenants, taking care of issues, so on and so forth. And that's market rate at 5%. The waterfall, you want to talk about the waterfall and then?
Yeah, I mean, it's fairly straightforward. So, our waterfalls change deal by deal, right? And the reason that is because we just look to try to achieve the best return for the investor and set it up and get creative to a place where we can deliver a return. Every deal is different, right? So every waterfall in essence should be different. If, this deal had different attributes, the waterfall would be different. So in this case, it's a 10 hurdle, right? Which means the general partners, David and myself, don't see any dollars until a minimum of a 10 compounded yield is achieved. And then after that, it's a 50-50 split. So if this deal, let's say the deal goes bad, right, or sideways, and we achieve a 9% compounded yield on your money, we see zero. We don't make anything. If the deal achieves a 13, then it's a split. In this case, we expect the deal to do very well and expect to deliver a 14% or greater yield to the investors compounded annually. So that's how the waterfall works.
Yep. In addition, the only other fee that there is we have an acquisition fee of the purchase price that's $100,000, and then a 1% fee on the exit of the sale price,
right,
when we exit. So this really creates a strong alignment of interest. Obviously, we're filling up the cup for the investors up to that 10% IRR, and then the splits thereafter. Going to show you just a couple other photos of the property. These are some interior photos of the various tenants. In the bottom right is the one for the moving company with all the drive-up bay doors. You have the CrossFit in the bottom left. Top right, you have the manufacturing company, and then the cleaning service company next to that. So we have some exterior photos that you could take a look at. We're going to just dive in quickly about some more background about us. We'll try to move through this pretty fast. So over the life of Lucern, which is approximately almost 7 years now, we've transacted on $250 million plus of real estate transactions. with a historical average IRR in the portfolio of 33% and a 1.7 multiple. Anything you want to add on this?
No, I think we discussed it a little earlier. Our track record has been very positive. We've done a variety of asset classes. We see really big opportunity here in light industrial. This will be I guess this is the fourth deal that we'll be doing in the light industrial space. The other deals that we have are exceeding our expectations currently, both pro forma and just general operational kind of benchmark. So we're very excited. We think it's going to be great, and excited to add another positive one to the track record. Yep.
And also on the transparency at the bottom, again, we have IMS, which is an investor management system that houses all of your documents, all of your historical returns. If you're multiple investments, you can run reports across that. And then we're also available to talk if an investor wants to have a one-on-one. We'll always set aside the time to do that.
That's right.
I'll pass through this. You can see our beautiful faces here.
One beautiful face.
One. Thank you very much. I appreciate that. Mark, who's not with us today, is one of our other partners, and he brings a lot of knowledge and background and has been in the real estate space since the mid-90s, had a strong background in appraisal and title, and has been an integral part of the growth of the firm. This just talks in detail about our investment approach and really understanding the assets and the markets that we're getting involved in, right?
Yeah, I don't think we have to beat this point in any further. I mean, we do deep due diligence, and we try to uncover opportunities that are overlooked and generate value, and we think that obviously this fits that box.
Yep. I have two examples of industrial projects that we are involved in. Ardenia is a New Jersey-based project, about 35,000 square feet, located in Monmouth County, the same area that our office is in. This was a ground up, and we're just coming to CO and have almost the entire building leased up. You want to touch on Cross Lake real fast?
Yeah, sure. And one of the things I'll point out about Ardenia really quickly is that it's an outlier for two reasons, right? One, we generally don't develop. It was a special situation. And two, it's in our backyard in New Jersey. This is actually the only asset we still own in New Jersey as a company. So I think that's a really important distinction there. But it speaks to the ability to do things outside of our comfort zone, outside of what we're doing normally, and then in areas that are different than where most of our investing takes place. And then separately, Cross Lake is here as well. So we bought this in August. We actually are purchasing this deal, Indeneer, from the same seller as Cross Lake. We built a relationship, and we were able to facilitate both transactions. We are currently beating our pro formas by between 19 and 29%. We're doing really well. Exceptionally well, much better than even I thought we were going to do, and I had high hopes for how we would perform. So it's a really nice asset, very similar in the sense that it's very proximate to a large interstate highway called I-77. It's in a really nice, well-off area. Mooresville is a very nice high-end suburb of Charlotte to the north, and a wide variety of uses in that building. We have everything from a chiropractor to a plumbing supply to a pest control to a moving company, tile company, flooring company, you name it, we have it in there. So we've done really well there, and really excited to take that same operational excellence and apply it to Indeneer here.
We'll be sending this deck out, and you can go through this chart which shows our track record. You'll see in the light blue the achieved IRR. You can compare that against the projected IRR. In almost all of the cases, we've beaten it. One or two where we are just right around the projected returns. But you could also see the type of investment that we've done, everything from ground up to distress repositioning to light value add. I think we always say that we're opportunistic. We like to be hyper-focused in specific markets, and then we look for opportunities that we can bring our skill set and knowledge to effectuate good returns for not only the firm, but obviously for you and all the investors that participate with us.
Look, I think one important thing to remember is we've done very well for a very long time, and right, investments are not guaranteed, right? It's a risky thing. It's not a guaranteed outcome, and if it was, right, the yield would be 2% or 3% or 4%, right, whatever you can get in the treasuries. So we have done well for a very long time. We are super confident and put our name behind this, and we sign on the debt for these things. So we are very confident in our ability to execute. But we have done well for a very long time, and it's investments carry risk.
Yep,
it's important.
We're just about wrapped up here. I think we got one more slide after this. This just talks about how we underwrite, what we look for in sourcing. I think one of our biggest strengths is sourcing, and I'll take my hat off to Frank, who loves shaking the trees every day and finding deals in the nooks and crannies. We actively manage our assets. We have great team and representation down in the Carolinas where we're actively investing. We're down there ourselves on a very regular basis.
It's also true. Yep.
So you'll be able to get to go through this. And before we open up for questions, obviously you can see our contact information here. I'd encourage all of you, if you have a level of interest, to write myself or to Frank, and then we can connect with you. From a timing perspective, we're penciled to close. If anyone knows real estate, you use the word pencil because they don't always close on the day you intend to. But we're penciled for February 9th. So our goal is to finish up with the commitments over the next week or two at most. And then we'll finish documents and call in for the capital at the beginning of February. So we would certainly welcome the opportunity to have a deeper discussion and see if this is a right fit for you. Again, even if it's not, we welcome those conversations, and down the road, maybe it's something that you would get involved with us. But we're here and available.
Absolutely.
So I appreciate you being patient, and we will now flip over and start answering some questions.
Thank you so much.